We're going to do a brief video on SP500, and we're using as a proxy for the SP500 this SP500 E-minis futures contract on the Chicago Mercantile Exchange. It's a great instrument to use as a proxy, and the question today is, could you have anticipated this huge drop that we just had today? This drop is enormous, and it caught some people by surprise. I'm sure cost some people a lot of money, but this was an over 200 point drop in the S&P 500, at least on the futures markets today. So the question is, how could you have avoided getting caught in all of that? Maybe a piece of it would have got you, but how could you have avoided such a big drop like that and being caught maybe long this market and not keeping a close eye on it? Well, the first thing is, whenever you're trading the S&P 500, you have to pay attention. When you're trading an index like this, you have to watch it, and you especially have to watch it if you're going the opposite direction of the current market trend. Now, when I say trend, there's always multiple trends going on at the same time in the market. But the predominant trend in this market right now, using objective measurements, is that the SP 500 is in a bear market. And we define that as anything trading below the 200-day moving average. Now you can see the 200 days in blue, it's sloping down. The green is the 5-day, and the red is the 20-day moving average. We're sloping down on the 200-day moving average, and we can see here clearly back in August 16th that it bounced right off it. So we can see that it's supporting, providing resistance for a rally to the SP 500. We're going to go back here in a minute and look at some historical trades in a minute, but let's keep an eye on right where we are. So we know this stock coming into this morning, this SP 500, we know it's in a bear market. So if we're long this, which is totally fine, we were getting a rally, it's totally fine, but you have to watch it, and you have to keep a very close eye on it. Because if you were long down here on the 7th, the 8th, the 9th, right, last Friday, if you were long over the weekend, you were going against not only a bear market, but you were going against a declining 20-day moving average. Now, if you take these off of here, you don't see that. If you just, I don't want to take them off because it takes too long to put them back on, but if you take these moving averages off of this, you wouldn't have noticed this. You wouldn't have noticed that it's using 200-day moving average as a serious resistance point. You would have noticed that the 20-day moving average is down against you. You wouldn't have noticed that you're essentially buying a bear market rally. All of those things were warning signs that you could be spanked. But if you don't believe in moving averages, that's fine. The other way you could have been given some kind of heads up is just look at the history of this market. This is an over 200 point day. So is that unusual? Not really. Look right here. This is not 200, but it's over, what is that? I can't do the math that fast, but it's way over 150. Keep going back here. Look at this one right here. That's what? Not 200, but it's almost 200. If you keep going back here, this one is 190. This one right here is, what is that? Over 200. So the point of it is, as unusual as this looks, it's actually fairly common. Now, admittedly, that's a heck of a sell-off, but it's actually fairly common in the SP 500. So when you're trading SP 500, and especially when you're going against the prevailing trend, you have to be very careful for these kind of volatile days. You'll notice that this move was at the bottom. This huge move here, which we said was over 200 points, was at the bottom of a downtrend. If you'd have traded that market, you should have been shorted because you're below the 200, below the 20-day moving average, and you're below the 5-day moving average. That would be the proper direction for that trade would have been short. If you're going to trade a counter rally here, and you're going to just buy a 5-day moving average and go against the 20, that's fine. There was a ton of money to be made there. But you have to be watching that intraday, and you have to pay very close attention. This is all my opinion for entertainment purposes only. But you have to be very, very careful doing that because you're going against the 20-day moving average, and you're trading right around the 200-day moving average. Now, keep in mind, we're discussing all this with the 200, the 5-day, the 20-day on the screen. If you don't believe in moving averages, you wouldn't know anything about the moving averages. And so you wouldn't have the opportunity to maybe adjust your concentration a little bit finer to avoid problems. There's nothing the matter with trading against a trend. There's tons of money to be made in it, in my opinion, but you have to be really careful. You take a look at this. You could have got in, say, here on this day, the March 18th, but you would have been with the trend at that point. You would have been going against the major trend, which clearly had begun to look down and were technically in the bear market. But the 20-day was moving up and the 5-day was moving up, so it's relatively safe. But when you come into a market like this, where you're below the 200-day, you're below the 20-day, you're below the 5-day, and you want to go long here, you're thinking about going long here, think about it. That might, if we can't really scoot this chart over, I guess we can try it here. It won't work right. But if you wanted to go long here, there's money to be made there, but you're going against all three moving averages. And if you did that and you weren't paying attention, you'd get spanked for another 200 down day. So the general guidelines, and the reason I'm doing this video is to just say a 200-day move in the SP500 is not that rare. It's not something that you are going to necessarily be able to avoid, but at the same time, you can get a really good heads up on how tight you should be watching the market. If you're trading the market counter trend, you have to watch it intraday, in my opinion. So this trend right here is a counter trend. You're buying in a bear market. Now it's safer because you have a 5-day moving up, you got a 20-day moving up, but to buy here, you're buying in a bear market, but you're going against the 200 and the 20. The only thing in your favor is the 5. Again, there was a lot of money to be made on that move going up. It's not a problem, but you got to watch it. You got to watch it intraday. If you saw our indicators, they flashed flat yesterday, and they also put a short out for this today. I'm not saying that because they're ours. I'm just saying that's what they did. The S&P 500 system that we use for trend following flashed flat yesterday and this morning before the markets opened, and it also put out shorts that were would have made you a ton of money if your own analysis said they were good shorts. So there's a variety of ways you can do it. And again, I'm not throwing ours out there just because they were correct. You have to do your own analysis. But without anything, without any type of guidance on here, you're really taking a lot of chance that you're not getting the proper perspective. So whether or not you like moving averages or not, we put on a 200-day, a 20-day, and a 5-day moving average, not because we think it predicts anything, because we really don't. We think it gives us context to make more intelligent decisions and to increase our focus. And we're watching intraday anyways, but even if we weren't, if you're going to put in a position that's counter the major trend, you probably want to at least consider watching that position during the day. It's not a bad thing to do even if you're trading with the trend, but when you're trading counter trend, and keep in mind we are in a bear market in the SP500 now, and we're in a bear market until we get a close up in this area above the 200-day supported by the 5 and the 20. So this is a bear market. Anything long here has to be watched extremely carefully, and that's generally the case whenever you're trading the SP500, especially if you're trading the futures. But as we just showed, you can minimize problems by increasing your focus and moving to a shorter, can't do it on this chart, but you can move to shorter time frames. An hourly chart is a phenomenal chart to look at if you're counter trend trading, and you can even go, if you have to, if you get really concerned, you go to the 1-minute chart and leave the same moving averages on there. Just leave a 5, a 20, and a 200-day moving average on there. Go to a 1-hour chart, see what it looks like. Go to a 1-minute chart, see what it looks like. And you're going to start looking at the market in a completely different way. And again, not for prediction purposes, but just to give you some idea of what you're doing and how the overall market looks. We put out, as we've told you a lot of times, these are out early. We put algorithmic trades out here today. I don't know if the futures are out for tomorrow. Let's check. Futures we put out for stocks. We also put out for futures. We have S&P futures out here for tomorrow's flashing a buy. So we have 1, 2, 5, 10, and 20-day holds at RBAM Research out for tomorrow. We put these out early as fast as we can get them out. These were probably put out before 6 o'clock tonight for tomorrow's 7 a.m. publication, but they're up early, so if you want to check them, they're sometimes up. But these are out for tomorrow, and you see we're flashing a buy. So if you were to make your own analysis and think buying was correct in here, this would give you some entertainment to come and look. You've got to use them for entertainment purposes only, but you come here and take a look. Again, 1 day, 2, 5, 10, and 20-day holding periods are the worst case. So if you bought in this column, after your own analysis said it was a good idea, buy tomorrow, close out the next trading day, worst case at a loss at the end of the next trading day just before it closes, or take your profits as soon as you get them. Same thing here for the 5-day. Buy tomorrow, assuming your own analysis says it's a good idea, close out worst case 5 days later before the market closes at a loss, or take your profits sooner if you get it. So that's how these work. We have another trend following system on here for SP500, but I don't think we've updated it for, let me see if I can find it right here. This is a 30-day hold. We haven't updated this yet. We'll do it in another hour. And you can see we had flash for this morning before the market opened, before 7 a.m. We had flat on here for the S&P 500. Everything else was a short, but this system flashed flat. And this is a moving average system, but a very complicated one that's built, uses moving averages, but it uses other things as well. So we did flash flat this morning for the SP 500. So that's the lesson. If you're trading counter trend, always pay attention. And if you need some finer detail, go to an hour chart and even a 1-minute chart intraday, so you can maximize your gains when you're trading against the trend. Get out properly and tune in and keep an eye for what we say what we've got going on for entertainment purposes. A lot of times we can give you heads up on these publications that we put out every morning before 7 a.m. that might help you adjust your own analysis. You can get them all for free at rbamresearch.com. They are available before 7 a.m. Monday through Friday, but sometimes, usually, a lot of them are up by 6 a.m. and everything's usually up by 6 p.m. and everything's usually up by 8 p.m. the night before. But we always say 7 a.m. the morning of. You can get 190 stocks, the major forex pairs, crypto, the major futures contracts, including the S&P that we just showed you, all at rbamresearch.com. Absolutely free, no credit card required. There's a link in the description below. You just go there and sign up to get them. If you like this video, please click the like button. If you want to subscribe, please do that. If you have comments about technical analysis, we'd love to hear them, especially moving averages. We use them all the time, but we don't predict anything with them. We just use them to describe. And that leads us to the fact that you can use everything we put out here for entertainment purposes only, including our commentary, and our entry prices have to be used just for entertainment purposes only. Can't use them for trading. You have to use your own analysis for that, and you definitely trade at your own risk.